In question 4 for Unit 11, we're once again saving money to buy a car. And again, we're starting with $23,000. The big difference is that instead of putting the money into a savings account, where it will earn interest which is taxed as income, we're using the money instead to buy stocks. When we buy stocks, we're buying a piece of a company. We are part owners of the company in which we own stock. And the government treats ownership different than income. If we own a piece of property, a car, a painting, a piece of real estate, or a piece of a company, and it increases in value, that is, we pay a certain amount for it and then later sell it for a larger amount, the difference, the profit, is not counted as income by the government. Instead, it's counted as what's called a capital gain. The capital, the thing we own, has increased, and that increase is called the gain. The two big differences are that this capital gain is not taxed at the income rate, say 29%, but currently at a lower rate of only 15%. And second, that we don't pay taxes at all until the time that we actually make a sale. So suppose we buy $23,000 worth of stock, and suppose that the value of this stock goes up, as our savings account used to, at 5% a year. Then the $23,000 worth of stock that we buy now, next year will be worth 5% more. Here's its value 1 year from now, and we can follow it over a number of years by dragging. Now, suppose we were to sell the stock that we bought after 5 years. If we were to sell it, we would get $29,354. Since we paid only $23,000 for that stock, the gain would be the difference, $6,354. And it's that gain that would be taxed by the government. So in order to figure our taxes, we'll need to see what the gain would be each year if we sold. That's easy. It's just the value of the stock minus the original amount that we paid for it. Here at the beginning, there's no gain at all. The $23,000 worth of stock is worth $23,000. But if each year we subtract off $23,000, we find, just as we noted before, that when the stock is worth $29,354, the gain is $6,354. The capital gains tax rate is 15%. So if we sell in any year, the taxes we'll need to pay are 15% of the gain. Here are the taxes. And so if we sell in this year, we'll get this much money, but we'll have to pay this much in taxes. The amount left, the amount that we get to spend on a car, is the total amount of the sale minus any money we have to pay in taxes. Here's how our spendable money increases over the years. If we sell in year 10, we'll have this much to spend on the car. Now let's just follow the price of the car and see when we'll have enough money. The car starts out at $26,500 and increases in price due to inflation at 3% a year. After 10 years, the car will cost $35,000 and we'll have $37,000, enough to buy it. In fact, we'll first have enough money to buy the car after just 8 years. We'll have $33,981 and the car costs a little bit less, $33,569. Remember that in a regular savings account we had to wait 27 years to buy the same car, starting with the same $23,000.